So tonight's session is sponsored by College Ave Student Loans. If anybody has been following me for a while, College Ave has been a very generous sponsor. They sponsor a lot of sessions like this on educating families. We do a lot with the loan season that is just kind of wrapping up a little bit. And they also sponsor a lot of these types of sessions throughout the year to educate families on these important changes that are happening with FAFSA. We actually have a session coming up in October that kind of talks in general about the financial aid process. We've got another session about the CSS profile. So I really want to kind of give them recognition because they really support a lot of the work that we do to help educate families. So thank you, College Ave. Okay, we want to keep going, Luanne?
So you're ready to get started?
Yes, go ahead.
Okay, so everyone, I just want to give just a little bit of a disclaimer. As Debbie said, this is still in flux. It has not been launched yet. I have been on a bazillion webinars with Department of Education for the last couple of years. Many of you may be aware or may not be aware that the FAFSA, which typically opens on October 1st, is not going to open on October 1st this year because they haven't completed all of the changes. These are the most changes that they've done in a 40-year history. So there's quite a lot going on. And so for some of you, you are old hands at this. You've got kids that are in college already, and you're wondering, oh, what are these changes? Some are brand new to this, and they're still trying to figure out, how do we pronounce this FAFSA? Is it FAFSA or such? So don't be worried, because it took me about 5 years in this industry before I could even pronounce FAFSA, correctly. But so just kind of sit back. We're going to go, kind of back and forth between what the FAFSA was up until right now and what to expect going forward. But still be aware that they're still making changes. And this is why I was on a webinar last week with the Department of Ed, and they're still saying sometime in December. By law, they have to have this launched by December 31st to be ready and open on January 1st. So my money is that we might be popping, the New Year's Eve champagne as the FAFSA is launched. So don't think that you have to, stay up and try to do all of this, the first night or even the first week that this opens. There's going to be so many changes. And when change comes with any kind of software system, there's just a lot of glitches that they have to work through. You don't want to be part of those glitches. So let's go ahead and get into this. So there's Debbie and myself, and I'm in Northern Virginia most of the time. That's where my home and my practice is. I'm right now up in Massachusetts visiting family that there was a death in the family, and so I came up to support my sister and brother-in-law. But like I referred yesterday, I'm part of a professional group of planners, and we've all been discussing this for several years now. And we had a powwow just amongst us, and broke down as far as what's going on, and maybe some workarounds and such that involve a lot of pre-planning. So I'll refer to that as we go along, but this is a big deal, but it's, what's done is done. All we can do is try to be as prepared as possible so that you go into this fairly informed. So FAFSA simplification, the agenda for tonight, why the change, what the EFC versus the SAI is. Remember, for all of you newbies, It's like learning a new language. So there's a lot of acronyms. And for all of you old timers, a lot of those acronyms that we finally realized have been changed as well. So we're going to go over some of the beneficial and maybe not so beneficial changes. I know that everybody is on tender hooks trying to figure out, well, what's going to happen to those of us that are divorced and separated. So we'll be addressing what we know right now, and then a few case studies, and if there might be some time for some questions. And I'm just going to say that if there are questions that we don't get to, or I don't have the answer for, we will get those. Typically, when we do things like this, we'll put all the questions together and the answers, and then have it a resource available for the group. So, with a new FAFSA, the Department of Ed comes up with a new infographic and a new name. So, the Better FAFSA for the future, everything begins with the FAFSA, and I've told people for probably almost 20 years now, I don't really care if you make Bill Gates kind of income, you still should file the FAFSA just to have it in your back pocket in the event that you need it. Because we just never know what's going to happen. Life twists and turns and such. But so let's go ahead and go into, some of the changes with the acronyms. So all of you old timers know the EFC, expected family contribution. Everybody hated their EFC. You see parents all the time in the Facebook group, oh, it's meaningless. It doesn't mean anything. Well, it kind of does. It's just nobody likes what they would receive, because none of us realized the cost of college was going to get to where it is. But the whole purpose of filing the FAFSA is just to find out, where do you land on the poverty level scale for the federal government, and do you qualify for any financial need-based aid coming from the government? And that's in the form of Pell Grants, subsidized loans. So most of us, or many of us, are never going to qualify for those Pell Grants or even the subsidized loans. But there's a vast majority that will. But when the people would get the EFC number, it was so confusing and so much misinformation, because they thought, well, that number means that's all I have to pay for college. And it's not. It's just that's the number that you would have to pay out of pocket before being eligible to receive any federal financial need-based aid. So they decided there's so much misinformation and so much confusion, we need to have something that is as far removed from expected family contribution and EFC. So they came up with the SAI, the Student Aid Index. And we'll go into a little bit more about this in some future slides. But that Student Aid Index is going to show, how much the student can benefit or qualify for the Pell Grant or the subsidized loans. So I'm just going to put this out there. It's a name change. All of the calculations they've been changed a little bit, but the ultimate is you're still going to get a number that is going to come from all these calculations on this federal form that is going to be shown to the schools, so to the colleges that your students are applying to, and that's going to give them an idea of what's this student's aid index, and are we going to offer them some institutional aid, or not, because ultimately it's still going to boil down to cost of attendance minus SAI now instead of minus EFC is going to equal the need or the gap that a family would need to come up with to attend that school. And so if you're applying to a school that meets 100% of need-based aid, that's wonderful. But I think we all know those are, they're kind of like unicorns out there. Not very many are going to get into those type of schools. So then we need to know what is going to be the percentage of the aid that a school will meet for that gap. And then how are they going to meet that in whether it's going to be grants and scholarships or self-help in loans and work study. And that's what I call the secret sauce. And once you know that secret sauce breakdown, it's very helpful to then, okay, is this going to be a school that's going to be on our somewhat affordable list? Or is this going to be a school that we'd love to attend, but is not going to be in that affordable category? So going forward, the DRT, or the data retrieval tool. And I know some of you have probably been following Debbie's group for several years and have been on the FAFSA reviews and such that we've done. You all know I have never been a fan of the DRT. I don't appreciate when information is transferred that we can't see the data. I mean, that's just crazy. And of course, there were glitches and such. So over the years, we could choose to manually input that data. And, it was perfectly fine. But going forward, the DRT is no longer going to be in place. And I, said, yay, but it's now being replaced with the FADDX, which is the Financial Aid Direct Data Exchange. And what this means is that the Department of Education and the IRS are going to be synced together. And so now, instead of just sending information from the tax return, but it just wasn't a seamless transfer. And you still had to input information from your W-2 and your assets and such. So now the direct data exchange is actually sending your 1040 over to the FAFSA to get populated, but there's no W-2 information. And so we'll have some case studies with that. Now, as we go back to the old, we've all been told, known as parents over the years. Now we are going to be known as contributors. So I had a big chuckle at that one. So, a student is going to log in to the FAFSA and invite their contributors. So we'll get into that a little bit later. The SAR, or the Student Aid Report, your student typically would get that about 3 days after the FAFSA has been submitted, and it breaks down the EFC number and all of that information, because most of the time families, when they hit submit on the FAFSA, they would close out their screen or they would miss the EFC number because there wasn't a dollar sign next to it. It was usually 00, and then the figures. So that's going away. And now that's being replaced with the FSS, the FAFSA Submission Summary. And when everybody comes together to the contributors and the student, and they've done their thing, nobody's going to see any kind of an SAI number until the student receives the FSS 3 days or so later in their email. So start making sure your kids realize a lot of pertinent college information is going to be going to their email accounts, and they have to start checking them. This is good practice. So the 1040 is going to now be known as the FTI, the Federal Tax Information, and the SNT, or Simplified Needs Test. So what the Simplified Needs Test was, it was, you know, if you earned up to a certain income and met certain qualifications, you would not have to disclose your assets. So now that's going away, and it's going to be called the AEAR, Applicants Exempt from Asset Reporting. So, you know, for something that was supposed to be simplified, it doesn't sound too simple in my mind. So this FAFSA Simplification Act, which is the Consolidated Appropriations Act of 2021, these changes, they've been working on them for several years. And this was actually supposed to have been launched 2 years ago. But they decided, because there's so much information and so much data that's being changed and such, that they said, we're not going to be ready. So that's why we're here today, still not knowing a date that this is going to be launched, but they did say it was going to be ready for 24-25. And so it's going to be launched for that. So it's possible, you know, the last 2 weeks in December, they might do a little bit of beta testing or such. We just don't know yet. So the whole purpose of it was to make things a little bit more equal and easier in a sense, but to open up the ability for more low-income families to be able to qualify for the Pell Grant and subsidized loans. So it actually is a good thing in a sense for those, the income cap for considering income was changed. It was 50,000 and now it's 60,000 adjusted gross income. So if your earnings, your adjusted gross income is under 60,000, very likely that you are going to qualify, or your student, I should say, is going to qualify to receive a Pell Grant. Maybe not the full Pell Grant, which is $7,395 is the maximum for 24-25, but they might get a portion, and they might get an offer for a portion of the subsidized direct student loans. So as a freshman, for those of you that are new to this, your student, as long as the FAFSA is filed, they can receive up to $5,500 in the federal direct student loans. It's split between the 2 semesters. And if you have financial need, according to the government and according to the schools, then they can break up some of that loan into subsidized loan portion, which is 0% interest while the student is in school. And then the $2,000 of the unsubsidized portion of that $5,500 is interest starts accruing from day one as it's dispersed. So if you don't have financial need, according to the government and the schools, then your student will still qualify for that $5,500 in loans, but it's all going to be unsubsidized.
So Luanne, can you just maybe, because there's a lot of questions and there's probably some people who are new, really quickly just explain what the CSS profile is, because we just keep referring to it, but like for people who are completely new, they don't know what that is.
Right. So the CSS profile, college scholarship search, there's like 240 or so schools that use that. A lot of the more selective private schools, but some state, what they call state Ivies, like UVA and William and Mary in my state of Virginia, University of Michigan, and so on. And so they use the FAFSA, but they also require the CSS profile, which is giving a deeper dive into your financial health of your family, and so that they can see how much of their institutional aid that they are willing to give to your student. And some of that will be in grants and scholarships, and others will be in, a percentage in loans. So once again, going back, you want to know what that secret sauce formula is. We have, been in a lot of meetings with financial aid administrators, and because of the changes to the FAFSA simplification, they are not going to be receiving as much information as they would have preferred. And there's talk that a number of schools are considering transferring, or not transferring, but adding the CSS profile where they've just been a FAFSA school in the past. So once again, we'll see how it's all going to roll out once it gets in the, once we see what's going to happen, next April and May, when all of the decisions are coming out. So does that help, Debbie?
Yes, definitely does. Yes, I think we can keep moving.
So again, changing the EFC to SAI was meant to, avoid confusion and such, but I don't know, from what I've seen, and I've seen a preview of the FAFSA screen by screen, and they might have eliminated a lot of the questions, but the questions that are there are more in depth, and there's a lot of changes, and I think it's going to be just as confusing if you don't read the directions. And that's usually what happens. The FAFSA itself is not so difficult, for most people. And I've worked with a lot of very intelligent people over the years that have made some humongous mistakes on their FAFSA because they're just not paying attention and don't give it the credit that's due, that it is an important form. So the SAI calculation is going to qualify a lot more families for the Pell Grant, but it's not like, just waving a magic wand that, oh, college is just going to be affordable for you now. You still have to make sure that you're applying to schools and understand what, is there going to be a gap of, that we still have to come up with a difference, and how are they going to address that? So that doesn't change at all. So some of the beneficial changes, we already discussed changing the name. The SAI is supposed to be, more user understandable. They will be able to go to a negative 1,500, whereas the EFC only went to a bottom of 0. So it doesn't mean that if you have a negative 1,500 SAI, that you're going to get so much more in aid. It's just going to allow the financial aid administrators at the school to understand that this is a family that really needs a lot of assistance, are we going to be able to help them? So that's the purpose, the beneficial change with that. Now, untaxed income contributions. So those of you that do your own taxes, you know that you get a W-2, and on that W-2, you've got certain boxes, and it's going to have your deferred contributions to your 401ks, 403bs, 457 and such. And so we would have to, on the FAFSA, we would have to go in and input the W-2 information into the data screens, because that doesn't show up on the 1040. And this also includes like your HSA and FSA deferred contributions. Well, they're only looking at the 1040. They're not taking your W-2. So all of those untaxed contributions, which in the past were added back to the adjusted gross income, because the government wanted to see, well, what is your earned income for the year? We don't care what you do on your tax return. We don't care that that's deferred income. We want to see what your full income was. Well, now they're not going to see that, and that's not going to get added back to your SAI bottom number, which is going to be very beneficial. And from a strategy point, if you have the ability to max out your qualified contributions, it's going to lower your SAI. Now, for some of you, if your income is such that it's not going to make a difference if you have a lower SAI, but you may save some money just because your SAI is going to be lower and it's going to be less cost of out of pocket, and you still are going to be able to put more aside for your retirement. Now, child support has always been assessed as income to the parent that's receiving that. And yes, I know child support is not on the tax return. It's the biggest mistake that parents have made for years, thinking that the tax return and the FAFSA are one and the same, and they are not. You're just getting information from the tax return, but the FAFSA has their own rules and regulations. So up until now, the child support that is received has always been assessed as income to that parent. And your income has always going to be assessed higher than your assets. Income can be assessed anywhere from 22 to 47% on the dollar. So your assets are assessed at 5.64%. So that's going to be a considerable savings for the household of that student. Another big one, which is really exciting, is the 529 accounts. So in the past for FAFSA, a 529 is a parent asset. So if you've got 4 or 5 kids and they all have individual 529 accounts, that's your parent asset. And it doesn't matter that the oldest is going off to college and the 3 or 4 other youngers, are still young enough that it's not going to, that's their accounts is in your mind. The FAFSA said, no, that's your parent asset. We want the balance of all of that. Well, starting in 24, you're only going to be assessing the 529 account of the student who owns for the FAFSA, because the FAFSA belongs to the student. It's not the parent's FAFSA, it's the student. You just have to include your income and assets and your household size and whatnot, but it belongs to the student. So they're finally changing this so that the 529 account is the only one that will be assessed is the account that's in the student's name. Again, if you're kind of close to the limit for possibly qualifying for the Pell Grants and such, there could be a place for doing some strategic planning for the future. And I'm talking about the future. Anything that is going on now it's just done, because
actually, that's a good point to maybe emphasize. We were talking about this before, unfortunately.
Yep. So it's still prior tax return information. So starting for the 24-25 school year, you're using your 22 tax return. It doesn't matter that we don't start filing this until January or such, and you're thinking, oh, geez, I'm going to wait and use my next year's this past 23. It's 22. So your 22 1040, which the majority of you should already know what those numbers are. That's the information that's going to be assessed. So we can't make any changes to our income. The assets that are assessed are as of the day that is filed. But I'm just going to put this out there because there's all kinds of questions all the time. Should I hide my money? Should I pay things down so that I won't have that extra $2,500 in when it comes time to file the FAFSA? It's your income that drives the figures. It's not so much the assets. All assets are going to be assessed at 5.64%. So unless you've got $500,000 or more in assets, it really isn't going to play that big of a factor. I would rather that you, if you can, keep your assets so that you've got breathing space for all of those extra costs that are going to come along, or emergencies and such.
Go ahead. No, finish up, Luanne. I have one question before you go to the next point.
Don't bring your emergency fund down to zero, because you're going to need it at some point, and you don't want to put those emergencies on a credit card.
So I've been trying to answer questions in chat. There's a lot of questions which I passed over only because I know we will get to them in the presentation. But there's one quick question here, which I thought is interesting. You mentioned that 529 accounts are now being assessed only for the current student. Somebody's asking, what if they have one account, which they've been saving in for both their students?
Then the full amount will be assessed. So
in theory, they could split it up before they do. Yeah, so you might want to consider that.
You have time right now to make that change.
Yes.
Okay. And a little bit more on the 529. So always the outside family support is, it's been a bone of contention. If a grandparent or somebody wants to come in and help a lower income family with a 529 or a gift of some sort or such, and it gets paid directly to the college, because once again, people are saying, well, they should pay it directly to the college so that they'll get that tax break. We're not talking about tax breaks here. We're talking about students losing financial need-based aid. And so in the past, if a grandparent was contributing some extra money and that student could qualify for financial need-based aid, they would, in probably 99% of the time, they're going to lose that free money coming from the government, because they no longer have the need as far as facts and figures. So that is being eliminated. So grandparents can help with 529s. They can help with gifts, your best friend, your sister, aunt, uncle, whatever. It doesn't matter. That third party support is, the student will not get penalized for that. On the FAFSA right now with the EFC, they would, if they received it, they would have to disclose that support the following year as student income, and that's assessed quite heavily as well. So that's going away. So that's a wonderful thing. And it's going to be easier for students that have unusual family circumstances. And, you know, we see these posts in the group all the time. My daughter, my son knows a student that is, you know, living on somebody's couch because the parents kicked them out, or they won't file the FAFSA, or so many different types of things. And there was little help available. And
go to bed. Good night.
Now there's going to be assistance, and we'll go into that in further detail in another slide. So now, you know, with all things positive, there are going to be negative changes as well. And the big one that everybody's concerned about, and that I've been so concerned about for years, ever since they started talking about this, is removing the number of family members in college from the calculation. So for you newbies, with, you know, this is your first year with FAFSA, and you've never heard of all of this stuff before. What this means is that in the past, if you had multiple students in college at the same time, it was like your EFC number would get divided between the 2 or 3 students. I mean, over the years, I've had triplets and multiple sets of twins that I've helped over the years. So there's a lot of families out there that have kids that, you know, are overlapping in college. And, you know, just try to imagine coming up with the cost of 2 kids in college at the same time, or more. But some senator, you know, got a bug in his ear and said, that's not fair. My constituents are complaining that they only have 1 child and their neighbors have 3 in college at the same time, and they're getting a break and we're not. And so ultimately, that's why the change happened. So we fought it, those of us that are in the industry. We fought that and we lost. So we've got a couple of examples of case studies to show you the impact. Possible loss of eligibility of grants for current students in college because of that removal of the family members from the calculation. So just imagine you have a student that is just, you know, got on campus the last couple of weeks. They chose that school because of we've got 2 that are in college at the same time, like an older brother or sister, and we got a lot of grant assistance because our EFC was so you know, it's not quite half, but it's pretty close. So, but what if starting in 24, that particular school does away with giving the same financial aid award, and all of a sudden you lose those grants? So what I've been counseling all of my clients for the last year and a half is we need to look at what would be the cost if we're just calculating 1 in college, and is that still going to be affordable? And so for this year, we were contacting colleges and asking them, okay, you've offered me, you know, this grant assistance, and with the new change in the FAFSA for next year, my sister or brother is still going to be in college. We're still going to have 2 of us. Is this financial aid award with the grant assistance, is that going to change? And they're either going to say, no, it's not, because they are a CSS Profile school and they have their own calculations. Or they might say, well, you know, we're not really sure yet because we're still waiting for the Department of Education. That to me is a red flag. And so then you absolutely need to know can we continue to afford this school if this happens? And so, like I always tell, you just need to know what all of your options are so that you can make the best informed decisions for your family. Now, these next two, the small business exclusion and the family farm exclusion, I think is tragic. So, we small business owners are the backbone of this country. We don't get a lot of the benefits that a lot of people that work for employers and W-2s and such, but they're still trying to fight these exclusions from being eliminated. So in the past, if you were a small business owner and it's a family-run business, family owners, no, outside of the family, and you have less than 100 employees, then the assets of your business would not be assessed on the FAFSA. They would be sheltered. It's still going to be looked at on the CSS profile, but if you were only going to a FAFSA school, that could be beneficial. Same thing with a family farm exclusion. If you live on a family farm and your income comes from farming, the assets of your farm were excluded from the FAFSA. They still had to disclose it on the CSS profile. Now that has been eliminated. And so now the assets of your businesses, no matter what size, no matter if it's a family, no matter if it's a family farm, are going to be assessed and counted as assets. So just picture the farmer out in Idaho who, has maybe got $1 million worth of farm equipment and land and such, but they only pay themselves maybe $60,000 a year because, it doesn't pay to be a farmer oftentimes. They are going to really notice, this is going to hurt. So if any of you are in the audience, small business owners and family farmers, then what you need to be aware of is you have every right to write a very strong appeal to the schools that you're considering for your student. And one of the positive changes to the FAFSA Simplification Act, which I didn't have on the slide, is that up until now, colleges could decide, you can put an appeal in. We're not going to even look at it. They can no longer say that. They have to consider every appeal that gets submitted and look at it for consideration. So the strength for those of you that are falling into these categories, lost grants and small business, family farms and such, is a very strong appeal. And that being said, I'm just going to let you know that the college financial aid administrators, they are just flipping out because they know that they're going to be inundated with a lot of work, more so than ever. So I do ask all of you, it's their job. They're not the owners of the colleges. They don't dictate the prices and they don't dictate the rules. They just work there, just like all of us have a job to work. So, don't get nasty with them. Don't be threatening. Don't be yelling. Just take a deep breath, be considerate. Like they say, you can get more bees with honey. But just take that into consideration. They are going to be overwhelmed more so than during COVID. So,
and just a quick clarification. You said this, but just somebody's asking: are small businesses and farms, are the assets assessed at the 5.64%
yes.
Rate as well? Okay.
Yes, but don't forget, you can also it's your net. So if you've got loans out on your business equipment or such, it's going to be what the, your asset minus your liabilities is going to equal what is left.
Okay.
Okay. Again, completely blind submission of data. That's a real sore point for me and many people. So, and a lot of you, and you're thinking, well, I don't trust the IRS. I don't trust the Department of Education. I'm going to continue to manually input. So what they've done with that is when your student logs in with their FSA ID and they're going to invite you as contributors, you're going to receive emails. And the first thing that's going to come up is for the student and the parents. And by the way, each parent that is on the 1040 has to have their own FSA ID now. So for those of you that have never done this, the FSA ID is it's your electronic signature that says, this is, I'm verifying that this is me, my name, my social, my date of birth, and it's your ability to electronically sign, all of these documents online. What's happened in the past, it was only the student and one parent that needed an FSA ID in the household. Now it's going to be whichever contributors are on the tax return, that they have to have their own FSA ID, and then it's going to come up. Do you authorize the IRS to send your information to the Department of Education? And if you say no, then that's okay. You can manually input your information. It's not going to go anywhere. You're not going to get an SAI number. It's not going to go to the schools. So your only choice is to, yes, I approve and authorize the transfer of my tax information. Now, for those of you that cannot electronically file your taxes because of past years of fraud or such, you're still going to have to manually input your information. But as long as you authorize that, yes, the IRS, I authorize the IRS to transfer the information about me to the Department of Ed, you'll be okay. You have to authorize it in order for all of this to work. And I know we're not going through the FAFSA line by line right now like we would, later on, but I'm just letting you know that the student logs in and they invite the parent and they put some basic information in there, and then they're done. And the parents are each going to receive an email that says, you have been invited by your student to input this information. And so then say mom does it and dad hasn't checked his email in like 3 years, doesn't know how to log in or his password or such. If dad doesn't check his email, then nothing gets finished. So none of this is going to be processed until all the parent and the two parents, if they're married, filing jointly. If you're, head of household or single, you don't have to worry about other people. But everybody has to complete their task, and then your student will receive their new FAFSA summary something or other. Even I don't have all of this down yet, in about 3 days. So I cannot stress enough how important that is. So, but you're still not going to see you still won't see the data that your student input, which I completely disagree with. And if you want to fight it, you have to fight it with the financial aid administrator. Don't bother calling FAFSA. They're not going to be able to do anything for you. And then you can insist on getting a redacted financial aid summary. So I'm sorry, this is not simplified. It's adding a layer of complexity to this that shouldn't be, but this is just what you need to be aware of. And the last negative change for those of you that are business owners and self-employed, you don't have an employer that you're in many cases, maybe you're not, you don't have a W-2 and you're 1099 to your business or such, but you have started a Simple or a SEP or a KEO. Those contributions do show up on the 1040 and they will be assessed as assets. So how is that fair for everybody when W-2 employees do not have to add their contributions, but self-employed people do? So again, there's an opportunity for if some of you are listening and your kids are in middle school and this applies to you, it's time to sit down and see, should we open up a 401k for our business? Do we need to restructure our business or such? I'm not trying to give you tax advice, but these are some of the things that it would behoove you to sit down with somebody who specializes in college financial planning and who knows how to talk to your CPA and accountant.
So Luanne, before you go to the next slide, a lot of questions about, particularly with both parents needing to have FSA IDs. What if the other parent just really isn't in the picture and they can't get a hold of that parent?
So then that you're falling under the separated and or divorced category. So you're separated. So, and be aware, some states, you're going to have a legal separation, which you didn't have to have before. If you don't have that legal separation, and I know that this is happening in California, starting in 24-25, you have to be legally separated with court documents, or you both, the exes need to be on the FAFSA. So it's going to be a state by state issue because like I found out in Virginia, there is no legal court documents for separation. So it's really kind of a gray area there. But if you are divorced or separated, we're going to get to that slide here in a second. But if a parent doesn't live in the same household, there's only going to be one parent that is going to be on the FAFSA. So if you can hold that thought, whoever asked it, we're going to get into a further discussion with that deeper.
Okay, one other kind of clarification, but what if parents were never married and the other parent is absent?
Okay, so if their parents were never married and they do not live in the same household, there's just one parent.
That's true,
so,
right?
It's
legal, right?
Regard. So you haven't had any contact with the biological parent for years. You may have to show some documentation. The schools will ask, because let's just face it, we could all say, I haven't spoken to my husband in 5 years, and he's hiding in the back bedroom, because of FAFSA. So they're going to ask for documentation, and you could get some documentation from the schools that say, yes, we've known that, the mom or the dad, it's not always just the dads, are not in the picture, have never been And, so you might have to get that kind of documentation to prove that. Go forward.
Yes.
Okay. So, divorced and separated families. Up until this point, it's the parent that the student lives with, their household, more than 51% of the time, that would file the FAFSA. What's changing is now it's going to be the parent who provides the most financial support is going to file the FAFSA. So in some cases, maybe the ex provides a great deal of child support and more so than what the parent that they're living with. And everybody's question is, well, how will they know? How is this going to be proven? And we have not been given any answers yet. It's the number one question that is asked on every webinar, and they don't have an answer yet. So all I can say is what I've been talking to my clients that are in these situations, and this is just kind of common sense. So the tax return is going to be transferred to the FAFSA. It would be a red flag if the student who is filing the FAFSA is not a dependent on that parent's tax return. I've never been divorced. We will have our 48th anniversary this year. So I have had a lot of clients that are in this situation. And I know that one year somebody's going to have the child on their tax return, the next year they swap back and forth. All I can say right now is if you guys can get along well enough, and a lot of families do, to look at the benefit to the student to eliminate the amount of loans and or help to get the most financial need-based aid, you might have to sit down with your accountant and see what's going to be the impact on the parent that is supposed to have the student as a dependent on their tax return if they don't have it. And you only need to go to that extent if the other parent is going to be in that category where they're going to receive a 0 SAI and the full Pell Grant. So everybody's situation is different. There is no cookie cutter answer to any of this. You have to look at each situation. And I have a family right now, 5 kids, and the dad has been insisting for years to have a couple of the kids on his tax return. The other 2 students that are in college right now have been receiving Pell Grants. With this change, I want to make sure that they're going to continue getting those Pell Grants. And so we've, talked with the dad and the accountant, and all of the children are going to be on mom's tax return, which is going to reduce her AGI to ensure that those students will continue to get that Pell Grant. Because dad isn't helping to pay for college at all. So we implored to him, can you look beyond? So hopefully that's going to help some families.
But to be fair, Luanne, right? Well, 2 things. One is, I think I had read that determining which parent provides the most, financial support is supposedly like this current year. So this current year, which parent is providing the most financial support is how they're going to determine it. But to your point, what is to provide? How are they going to figure out who the actual financial support? There's no information about that. But what the other thing I was going to bring up is, even regardless of who they claim needs to fill out the FAFSA because of, who is providing the most financial support, it's based on taxes which are already done. So what you're explaining is good information, but it's only going to impact in future years. It's not going to impact this current year.
Correct. So,
I just want people to understand that.
Yes, yes. See, I'm a big forward planner. So I love it when families that their kids are in the 8th grade come to me and say, what do we need to know about all this stuff? Because the earlier that you start planning, the better off that you can be to make college to be more affordable, to, try to eliminate debt and such. This has all been in the works for like the last 2 years. So those that have, met up with people like me, we're in the know about this, but the vast majority of you're just learning about this now. So unfortunately, there's not anything that you can do at this stage for 24, 25, other than understand what these changes and what's going to be the impact on your family. And again, then it's going to depend on the schools that your student is applying to try to make sure that they're going to be affordable. Because some of this is going to make a huge negative impact on a lot of families. So the income protection allowance, like when I was just talking about my client who has 5 children. So if all she had were the 3 children, her first $29,000 of income would be protected. And then beyond that, it's going to be assessed. With all 5 children on her tax return, now her income protection allowance is $42,000. So that's going to be more beneficial. She is a lower income mom who gets very minimal child support. So this is going to ensure that the 2 kids that are in college right now will continue to be able to get their need-based aid. The asset protection allowance is back again. The last couple of years, it's been 0 for both single individuals and, couples that are married filing jointly. But as you can see, there's not much there. So 10 years ago, a age of oldest parent being 60, that asset protection allowance for 2 parents was close to like $62,000, which means that your first $62,000 would not be assessed. Anything after that is assessed at 5.64%. Now, most of you are probably going to be around that 50-year age bracket. So $7,000 for a couple, $2,700 for a single parent. I mean, it's almost like you don't even try to throw that into your calculations. It's so, it's like a slap in the face. But, every little bit helps, I guess. And with the business and the farm adjustments, it's not dollar for dollar. So there's going to be the calculation here. If let's say that your business has up to $140,000 in assets, it's going to be 40% of the net worth of the business or farm. And so all of these calculations are built into, as you input the information, it's built into the FAFSA itself. And so that will be calculated. But if you want to be proactive and, do these paper pen and paper calculations yourself to get an idea of what to expect. So I mentioned before the students with unusual circumstances, and so many of us don't really realize how blessed we are. There's kids out there that are going through some horrific things, human trafficking, their parents are in jail, or they've been, abused or abandoned by their parents. So this is, I think, probably one of the most important things is those kids are just not going to be left on their own anymore. The financial aid administrators at the schools, they're going to need documentation and such, but there's going to be help out there for these kids. Once again, it's not going to ensure that they're going to go to college for free, but they're just not going to be left out in the dust with nobody that's in their corner. Now, and we see this all the time, occasionally kids will get on the forum and say, I can't get my parents to give me their financial information. So it happens a lot. And again, it's going to have to be documented, because if all we had to say is, well, I'm just not going to give my student the information, all they're going to be able to do is to get the unsubsidized portion of the loan. So for a freshman, it would be a total of $5,500 in an unsubsidized loan. They're not going to be able to get any kind of grant assistance or such, but it could give them the ability to at least start at community college. Again, here's some help for those kids out there that are struggling and just have nowhere to turn. There will be some help for them. So here's a few case studies. And this is, just showing the difference between the EFC versus the SAI. And this example is two parents with one student. So on the left, this was the EFC with you're inputting your W-2 information as well as line items on the 1040. So they had $91,000 in earnings. Mom and dad contributed the max to their 401k. They had a $10,000 HSA account. Those three items are tax deferred. So their AGI is $40,000, but the FAFSA of today, 23-24, would say, well, we need you to add back in the health HSA and the contributions to your retirement accounts. And that's how we come up with a $24,000 EFC and no ability for the Pell Grant. Now, when we're using the SAI and with the 1040 only, the same figures, but it stops at that 40,000 AGI. The tax deferred accounts are not going to get added back to the AGI. So now they have a 0 SAI, student aid index, and can qualify for the maximum Pell Grant of $73.95. So it's going to open up the door for a lot more families to get that Pell Grant. Now, this case study is showing, okay, it's not just for low-income families. So again, we have the same scenario with the SAI, and the parents are maxing out their contributions and stuff. They still get a 0 SAI and a Pell Grant. With the same outcome for that family that is only earning $40,000, they're not contributing to their retirement accounts. They don't have health insurance. In fact, they had to buy health insurance with after-tax dollars. and their AGI is 40,000, they do have a 0 SAI, and their student will receive the Pell Grant. But it's a substantial difference. Now, that being said, there aren't too many families that if they have a 91,000 earnings, they're unlikely to be able to qualify the maximum amount to contribution to their 401k plans. But this is just showing you the reality out there. Every now and then you are going to have somebody that's going to be able to max that out. So again, it's not cookie cutter, and it's not, oh, geez, I make too much money, I'm not going to qualify for anything. As you can see, there are differences. And so everyone should do these, submit their FAFSA.
So Luanne, a quick question about retirement contributions. We're saying, the 401ks are now like not considered, they're not being added back in for, AGI. You didn't mention, or I don't think you mentioned, traditional IRA contributions. What's happening with those?
The traditional IRA is going, like I said before, with the SEP and Simple, the KEO and the IRA, that's not tax deferred. So, let me step back there. Your Roth IRA contributions and such. So it just depends on how it's set up, but it's those IRAs, traditional IRAs, are going to fall under the same category as the SEP, the Simple.
So they are. Yeah. Okay. Because we kind of talked kind of more specifically as it relates to like business owners who might have those retirement accounts, but we didn't really say for people who might be putting away in just regular traditional IRAs. Correct.
So in this scenario here, and I can't, this is the one, I've got something right in the way. Yeah. So this is from last year. So I have a student who applied to the University of Pittsburgh, and it's not a CSS Profile school. AGI 143.6, assets 146,000, no equity, didn't own a home. Their EFC with 2 siblings in college was 20,000. In the parentheses, you see the SAI would actually be 35,941 with these with this data. The student wasn't offered any merit. They were offered a $9,000 grant. The net 4-year cost, and take this with a kind of a grain of salt, because we don't know what the future increases are. This was calculated using a 3% increase each year. So their net 4-year cost would be a little over $200,000. Now, we ran the figures without the sibling. These were twins. And so with only one in college, their EFC was going to be 38,000, but their SAI is 35,941. So with the EFC, they were only offered 2,000 in grant with no sibling discount. So their net cost, which is not a substantial difference, is like $7,000 or $8,000 over the 4 years. But for a family with assets of only 146,000, that's a pretty expensive school. So again, you just have to you have to run the figures. And so this is a different family. Income is a little bit lower, but had some substantial assets. And the student was applying to Duke, another family with twins. I attract multiples, I think. But with the sibling discount, we're looking at an EFC was $42,000. And the institutional calculation came up to roughly about $61,000. So he received a $46,976 grant, no merit. Duke doesn't give merit. So a net 4-year cost of $188,000. This particular family had been saving, 4 years, and that was doable for them without taking on any loans. Now, with no sibling discount, the same figures, the same data, the EFC would be $81,000 and institutional $100,000. So that's the institutional comes from the CSS profile. It's not a figure that you get from the school, but I have software that calculates all of this. So in this scenario, no merit, no grant, and the 4-year cost, almost $400,000. So they were able to make decisions based on this data. But what we did was contacted Duke and, like I said earlier, asked the financial aid office, our situation is going to be the same in 24-25 with myself and my sister in college at the same time, but the FAFSA is changing. Am I still going to get offered a similar grant award? Are you going to consider the multiple students in school? And so this was sent in an email, and they replied, so we have it in writing, and they said yes, that they will honor that going forward and still consider that in their calculations. And if the parents' income and assets were very similar, they should expect the same award, which then gave them, and knowing that the SAI is going to go up a bit from the EFC figure for 2 in college, but it was worth it for this family to accept that. So they were fully informed, it was going to fit into their budget, and it was, they just ran all the figures. And that's what we all have to do. So as we get to the end here, there's, Debbie and I talked about this, are we talking about winners or losers? And that sounds a bit harsh. So positive and negative impact on advantage and disadvantage. It sounds a little bit nicer, but those that are lower income families under 60,000, adjusted gross income, very minimal in assets. In fact, in many cases, they're not going to even get asked what the assets are. The assets wouldn't be considered. So that's going to be a benefit for those lower income families. But again, it depends on the college that you're applying to. Are they going to make up the gap in 100% need, or is there going to be a mix of loans as well as grants? And students that have grandparents or other people that are helping the family to pay for college and such, I mean, the student is no longer going to be penalized for that outside help, which I think is wonderful. The one thing that I haven't seen addressed yet, and I've got a feeling somebody's going to have to ask this, but what about third-party scholarships? How is that going to be addressed? Because that's also coming from an outside source, but I don't think it's going to fall into this same category as a familial, contribution. So I am trying to find that information. Now, those that are going to be mostly disadvantaged are those that have multiple students in college at the same time, students with divorced parents that it might change the table that the parent that the student lives with, which is a much lower income and assets, and they're able to get the grants, that table might get switched if the other parent provides more support. So that's still yet to be determined how they're going to prove this. So some of you have a 50-50 arrangement. Where does it draw the line? We just don't have those answers yet. And, you know, those families, students that their families own their own business or the family farm, you know, they're the ones that are going to get hit the hardest, I believe. And they don't have time to make adjustments for this upcoming year. So they just have to, you know, be as informed as possible so that they can make sure that they're going to be making affordable choices for their families.
A lot of information. Thank you, Luanne, to go through tonight. I've been trying to keep up as much as possible answering comments, but I have not gotten to all of them. But some earlier themes that I didn't address because I thought we could talk about it because it came up a lot was, what are you hearing about early admissions and how, you know, all of this is going to impact early admissions and when people are going to find out the financial aid information. I mean, the deadlines for the students' applications are really basically staying the same, somewhere starting between October 15th to the November 15th. But because of the delayed FAFSA, colleges obviously may not be able to provide financial information. So what are you, what's your idea of what's going to happen?
So, you know, the colleges have been working on this for over a year now when they announced that they weren't going to be ready for October 1st. And, you know, especially those of you for early admissions, you get your application in and you'll find out if they're going to provide any merit scholarships. Usually with early action, they're not finding out the full financial aid award until much later.
Because you don't have to make a decision. So I'm saying for early admission students and families, they don't have to make a decision. So that's why, even though you might want to have the financial aid information earlier, it's not going to impact you immediately.
Correct. It's the early decision applications that everybody's so concerned about. And quite honestly, those are schools that, for the most part, use the CSS profile. So I didn't address this earlier, but the CSS profile still opens up on October 1st.
And it's not really, not that we know of, changing that much from previous years.
Correct. It might have some interface changing. You know, they usually have something change every year. But they're still opening up on October 1st. So,
yep, go ahead.
So, you know, you need to look on, you can just Google CSS Profile schools or go to thecollegeboard.org and look up the list of the schools that accept the CSS profile to know which schools are going to require that. You're still going to, you know, typically people, what they've always done for, you know, almost the last 20 years that I've been doing this, we file the FAFSA and then we file the CSS profile. For my clients, we do the two at the same time. But a lot of families that are doing this on their own, they've always filed the FAFSA first because they want to get that EFC number. And then they decide, are we going to fill out the CSS profile? The FAFSA was a nightmare, and they say that the CSS profile is worse. So, but for this year, for those of you that are submitting early decision applications, I don't, you know, don't quote me 100%, but I don't know too many schools that accept early decision applications. Why I say that? Because Virginia Tech, as an example, it always had an early decision application. They stopped it this year, but they were not a CSS profile. So that being, you know, sometimes I just have to work it out in my head. All I can say is for those of you that are considering early decision for a school that does not use the CSS profile, is to contact the financial aid office and ask them, how are they going to address this for early decision applications? And we don't have a concrete answer to give you. You know, in situations like that, you always go to the source, and that in that specific school. Don't take somebody's vague answer. Go to the source, and you don't have to have your student do this at this stage. You as the parent can call and just ask a general question. Your student can send an email to financial aid, but it doesn't have to be the student that is going to make that call.
So there's been a few questions. You know, we're talking about the CSS profile. This whole issue about whether multiple students in college at the same time are considered, I just want to make it clear to people, is a FAFSA change. Maybe you can talk about, is this a CSS profile change, and will colleges can still consider multiples in college, multiple students in college, if they are using the CSS profile?
Sure, that's the case studies that I just showed you, like for Duke, which is a CSS profile school. So the schools that use the CSS profile, they've always used their own calculation. Doesn't matter what the FAFSA said. So they use the FAFSA for, okay, is this family going to receive any federal need-based aid? But most of the schools that use the CSS profile, they're giving of their own institutional aid. So that's why they use the CSS profile, do a deeper dive. They want to know the balances of your retirement accounts, the equity in your home and such. Not that they expect you to use that. They just want to know your financial health. Are you going to be somebody that's going to be able to afford to keep your kid at their school? Because they want your student to stay at that school. So that's the enrollment management part of the behind the scenes that most parents are completely unaware of.
So just to kind of emphasize that, what we've been talking about tonight are FAFSA changes. They are going to impact, strongly impact the schools that only use the FAFSA. The schools that use the CSS profile, they may not be impacted by this, other than determining what type of federal aid you might get at a school that also asks for the CSS profile. And then the other thing I just want to mention, you know, I mean, there's a lot of people on the call and who are chatting who are, you know, understandably concerned. You know, I get it. But if you were a family who was never going to receive any sort of financial aid, whether you filled out the FAFSA, whether you filled out the CSS profile, I mean, for good or for bad, I mean, you're still not impacted, you know? So if you were never expecting any aid, and, you know, if you could pay for it in full, you're probably not on this call anyhow. But I mean, if you weren't expecting any aid and you just are looking for merit, you're kind of still in the same situation. You're not impacted by the changes that we're talking about. But obviously, families that used to get aid from a FAFSA school that had two in college, they're impacted. Divorced families are impacted. The parents with farms and small businesses are impacted. So, you know, there's, as we said at the end, there are families who are affected, families that, you know, might benefit from some of the changes, and then there are families that, to some extent, this isn't going to make a change one way or the other for what their outcome is.
Correct.
Okay, there were a lot of questions about the 529 plan.
Mm-hmm.
Maybe if you can give a quick clarification, because I could see that there was confusion, people even understanding actually who the owner of a 529 plan is versus, you know, the beneficiary. This question about changing ownership from parent to a grandparent. Should they consider, there were two questions: changing ownership from a parent to a grandparent, and potentially shifting money out of a 529 for one student to a younger student?
Right. You know, with all things, it just depends. You have to look at individual situations. So a lot of folks have asked, well, geez, if the 529 is still going to be considered a parent asset, then, and the grandparent isn't going to be penalized, the grandparent 529, shouldn't we just transfer our 529 over to our parents? And I mean, technically you could do that. Are you going to benefit from doing that? Is your income low enough that it's going to make a difference? Probably not for the vast majority of families. So you always have to look at, is it going to be worth the hassle and the risk of doing this? Because if you were to transfer your 529 to your parent, so I'm a grandparent, and my daughter transfers the 529 for Jack over to me as the owner. Jack is still the beneficiary. And something happens to me, I have a stroke and I can't, I'm gone. I get hit by a bus. And now suddenly, if it wasn't set up correctly, that 529 is going to be sitting there without easy access for them at the time that they need it the most. So, you have to, if all it's going to save you is a couple $1,000s of assessed value, is it worth it for that risk and the hassle? And maybe your 529 administrator only allows like one transfer a year or such. So unless you're really going to benefit and you're going to be able to qualify for those, the full Pell Grant and the subsidized loans because of low income, it might not be in your best interest to do that.
What about the shifting of 529 money from an older student to a younger student who isn't going to college yet?
The same thing. It's timing. So it's, again, are you going to benefit from making that shift? Is it going to have an impact on your bottom line? And if for most families, if they've got that type of an amount in a 529, they've got the income that's been supporting that. So it probably isn't going to make a difference. For the risk, for the paperwork hassle, and again, depending on their 529 administrator, how often can they move from one account to the other? So I have a client this year whose grandparent was the owner for his twin daughters' 529s. And so the grandmother is starting to, she's older and having some, starting to have some cognitive issues and such. So they decided they're going to transfer from the grandparent over to her adult child, the dad. And they didn't, they weren't, it wasn't from a standpoint it was going to lower anything, or it didn't matter. So you just have to be aware of, just those life circumstances that can make a difference.
Okay, two other quick questions and then we'll wrap up because it's been a long night. Can you just, we didn't actually talk about this, but I think it's a quick response. What about students that are currently receiving merit scholarships, or just what about merit scholarships in general? Do you think there's any impact to how colleges are going to distribute merit scholarships based on these changes that are happening to FAFSA?
Well, I mean, merit is on the merit of the student. So I don't think it's going to make a difference. You know, there are some schools that they require a FAFSA to be on file in order to give merit, but it's not because of the income and assets of the family. It's just, you know, there might be a teeny tiny portion of some federal monies somewhere that, or the endowment that is paying for that merit scholarship. Somebody might have said, we want FAFSAs on file. You know, we want to make sure that they're utilizing all sources of aid, not just the free money. So there are schools that still require a FAFSA to be filed in order for the student to receive merit, but it's not on, you know, it's not on your income and assets. So I don't see that there's going to be any change.
Okay. And just the last question, we talked about it, but just to reiterate it, is just confirm, or you can't really confirm, but just say when you think that the FAFSA is opening this year, and and there are a lot of questions about, I think, people being concerned that there's some deadline that they're going to miss, like when it's, you know, when's the last time that they can file?
Well, there are still families that are filing their FAFSA right now for the 23-24 FAFSA year.
Right. I don't think people recognize or understand actually the real deadline, but it's a federal deadline of when the last time it is that you can file. FAFSA is usually, like for this upcoming year, for the 2024-2025 FAFSA, it will actually be June 30th of 2025.
Correct.
Right.
So the deadlines that you need to be aware of are really the state grant deadlines.
Yes.
So there's like I think it's about 7 states, and please, I should have looked it up because I figured this question was coming, but you know, I'll look it up and I'll get it to you, Debbie, that you can share. But there's, I think it's either 7 or 8 states that do, when you file,
they have early deadlines.
They're connected. And so it can be an automatic connection to that state grant money. And so they do have their own state deadlines for those grants. You do not have to file the first, you know, the first week. It's going to be a nightmare. So all of you people that have been listening tonight, just realize you're not going to lose anything by just sitting and watching and waiting a little bit, because you're going to get so frustrated with that site going down left and right. And you know, you're going to have to restart again, and it's just going to be a real mess. So those are the only deadlines. If you are a low income family that is going to qualify for state grants, then you want to get your FAFSA done, I would say, at least by week number 2, because sometimes, depending on the state, that money does, you know, will run out.
Well, I mean, to be fair, and then the third deadline is the colleges themselves do have financial aid deadlines that they want these forms filled out by, regardless of the state or the federal deadlines.
Right. But they're not, also, again, they're not immediate.
Right.
So you've got time. Look up the college that your student is applying to, and it's going to tell you what the deadlines are for financial aid. And your FAFSA and your CSS Profile are going to all have specific deadlines, especially the CSS Profile. And if you miss that deadline, you're not going to get any kind of institutional aid or you know, their assistance at all. They're very strict. So, but again, the CSS Profile does open up on October 1st. The FAFSA, and I saw somebody, you know, somebody answered, when does the FAFSA open? And somebody said October 1st.
Right.
So they're not listening, but it's going to be sometime in December. They have not given us a date yet, but the last date that they have to launch this is December 31st. It has to be open by law on January 1st.
And the last thing, and I'm just bringing this up because I realized that we might have confused people. In the scenarios that you were showing, some of the scenarios you showed equity. And I think people were confused asking, is equity taken into account for FAFSA? So maybe you can just explain whether it is or isn't and why it was on that example.
Correct. Yeah. So the equity example was there because it was a CSS profile school. So some CSS profile schools are going to assess your equity and some don't. And some will assess it at 100%, like NYU, and some assess it at 0, like UVA, or some will do 1.5 times your income. So they all have their own
income. You mean the equity? 1.5 times the equity?
No, 1.5 times your income.
Oh,
yeah. It's they make the rules. Each school makes their own rules. So it's you can contact the school and ask them, do you assess the equity in our home, and how do you assess it? Most will not give you their calculation, but so it's not something that's easy to find out, but you know, it is out there. So no, you do not have to assess the equity in your primary residence. That is one of the few things that is still no longer assessed on the FAFSA is the equity in your home, any cash value inside life insurance or annuity qualified contracts, your qualified retirement account balances, and you know, we used to throw in the business assets, but that's no longer there.
okay. Well, there are a ton of questions. We will probably look at the chat and see if we can write some of these up over the next week or so. But thank you so much, Luanne, for all of your knowledge, for trying to gather as much intel as you can. It's like from the secret sources that are out there.
Oh my God. It's you know, this has been going on for a couple of years now. And, you know, I was in the group that I was with yesterday online. It was amazing. There were some CPAs there that are also helping with college planning, and they didn't know some of these answers. So, you know, just be careful who you listen to. You've got to do your due diligence. A CPA or an accountant or a financial advisor that don't specialize in college planning, you know, they have their own specialties that they're working on, and they're just not as
you really have to be, you know, on top of things, as you can tell, especially this year.
Yep. This year more than any other. So, but this year has been building up. You know, it was supposed to happen 2 years ago.
Yeah.
So,
yeah.
But just you know, just take a deep breath. Don't get panicked. Don't, you know, have anxiety attacks. It's just I didn't realize that. You just have to be careful on the information that you are receiving and make, you know, informed decisions as far as the schools that are going to be affordable for your family.
Thank you, Luanne. Thank you again to College Ave for helping sponsor this. And, you know, this is just the start of kind of information. We'll, you know, be trying to provide ongoing information from now until whenever this opens, sometime in December. And it will be an interesting fall, is all I can say.
I can tell you what's going to be the most interesting is the FAFSA review.
Oh, yes. yes. When it finally does open. Yes.
Yeah. It's going to blow you away, Debbie. You know?
Oh boy. Okay. Good night, everyone. Thank you, Luanne.
Everyone. Thanks, Debbie.